Within the next 48 hours, this market is going to trap millions of investors. And if you're not paying attention right now, you could be one of them. I'm going to show you the exact setup happening at this very second. The same pattern that preceded every major market reversal in the last 5 years. Stay with me because this next part is critical. Hey, welcome back to the channel. If you're new here, I'm your name, and on this channel, we break down what's really happening in the markets. Not the mainstream narrative, but what the data is actually telling us. Today is Tuesday, June 2nd, 2026, and what we're seeing right now is textbook bull trap territory. Here's what you're going to learn in the next 13 minutes. 1. Why yesterday's record highs in the S&P and Nasdaq are actually warning signals, not reason to celebrate. 2. The hidden divergence between stocks and crypto that's screaming danger, and why professional traders are already seeing this. 3. The exact price levels you need to watch right now. Miss these and you'll be caught off guard when the move happens. 4. How to position your portfolio before the reversal, so you're not panic selling at the bottom. And 5. The geopolitical and economic catalyst that could trigger this thing tomorrow or next week. Let's go. Here's the thing that most financial media won't tell you. Hitting new all-time highs is not bullish. It can be. But right now, it's dangerous. Let me show you what happened yesterday. Monday, May 31st, the market was on fire. S&P 500 closed at 7,500, 99.96, up 0.26%. Nasdaq hit 27,086.81 for the first time ever, gaining 0.42%. Dow added 46 points to 51,078.88. All three indexes hit new all-time highs. This was the headline everywhere. Historic record highs. Stocks keep climbing. But here's what almost nobody is talking about, and this is critical. Bucks. Look at what happened in the first few hours of Tuesday trading. S&P 500 minus 0.14% to minus 0.19%. Nasdaq minus 0.25% to minus 0.1%. 0% Dow minus 0.09% to minus 0.41%. We're already rolling over, and this is typical of what I call a distribution phase in the market. You see, when a market makes a new all-time high and immediately pulls back, especially after 9 consecutive weeks of gains, that's not a dip you should buy. That's smart money getting out. Think about it logically. If you've been holding a position that's been winning for 9 straight weeks and you just hit a new record high, what do? You take your profits. You lock in gains, you move into cash or defensive positions. That's exactly what's happening right now. And here's the statistic that should worry you. When the VIX stays this low, we're at 15.75 right now. While markets are rolling over, it means complacency is still high. People don't realize what's about to happen until it's too late. The VIX at 15 is saying everything is fine, but the charts are saying something completely different. Stay with me because this next part connects everything. Okay, this is where it gets real. We're looking at what technicians call a bearish divergence, and it's already in motion. Let me break this down in 3 parts. Part 1. The setup, look at the Nasdaq chart. Since February lows, we've had a consistent uptrend. The market kept making higher lows. Buyers kept stepping in. Every dip was purchased. This is what's supposed to happen in a bull market, right? But last week, May 28th, something changed. We got the highest PCE reading in nearly 3 years. That's inflation data, and the market went uppy anyway. That's not normal. That's not healthy. That's manipulation or desperation. When inflation data comes in short and markets rally instead of selling off, it means the market is completely decoupled from fundamentals. It's purely momentum and AI euphoria. Part 2. The warning signs. The Nasdaq hit 27,000, a psychological level. The S&P approached 7,600, another major resistance. And instead of breaking through, we're seeing rejection. Rejection at resistance after a long rally is exactly what happens before a sharp reversal. Here's the pattern to remember for the rest of your life as an investor. When you see a series of higher highs, but the volume of buying decreases at each new high, and then you see rejection at a key level, you have a set up. That's what we have right now. Part 3, the crypto divergence. This is the smoking gun. And here's where it gets really interesting. While stocks were hitting record highs yesterday, look at what Bitcoin was doing. Down 6.12% to $67,116. Ethereum breaking below the $2,000 support level, hitting lows near $1,963. Rejected. This is critical. Bitcoin and Ethereum are the risk-on assets. When risk-on assets are declining while stock indexes are rallying, it means the rally is artificial. It's sector-specific. It's not broad-based. Specifically, it's been the Magnificent Seven tech stocks: Nvidia, Meta, Apple, Microsoft, Tesla, Alphabet, and Amazon. These 7 stocks have been carrying the entire market, but the moment the rest of the market, the Russell 2000, small caps, cryptocurrencies, start breaking down, it's a warning that the rally is exhausted. And that's exactly what we're seeing. Crypto outflows, $1.42 billion in spot Bitcoin ETF outflows just yesterday. That's money leaving the market. Professional money, smart money. When pros are leaving, retail is left holding the bag. That's the trap. The trap is sell the news at the top. Let retail get excited about record highs. Then pull the rug. Crash the market 10 to 15%, shake out the weak hands, and buy at the lows. We're at the sell the news part right now. Tomorrow, Wednesday, Thursday. That's when the shakeout begins. All right, let's get tactical. These are the exact levels I'm watching, and if these break, you know the trap has been sprung. For the S&P 500, the top of the range is 7,600. We haven't closed above it, so that's still a failed breakout. The critical support is 7,550. If we close below 7,550 on high volume, we're in trouble. The next target would be 7,450, then 7,350. Why? Because after rallying from 7,200 to 7,600, if we break down, we won't stop at 7,550. We'll cascade down to the 200-day moving average or the 50-day. Those are key support zones. For the Nasdaq, the same story. 27,000 was a historic first. The market couldn't hold it. Every time the Nasdaq has rejected at a round number psychological level like this, it's rolled over hard. Support at 26,800. If that breaks, 26,500, then 26,000. For Bitcoin, this is important because Bitcoin is leading the way down, which confirms the overall weakness. Resistance, $70,000, already broken. Next support, $69,000, holding barely. Critical support, $67,000, we're near it. Break below $67,000 and we're heading to $60,000 territory. Some analysts are calling for $58,000 by mid-June. For Ethereum, $2,000 was broken today. The next support is $1,900, then $1,800. If Ethereum closes below $1,800, we're in full capitulation mode. That's when you start hearing stories about margin calls and liquidations. The calendar catalyst. And here's what could trigger this reversal imminently. We still have geopolitical tension with Iran. Oil prices spiked. The Fed is about to change leadership. Powell stepping down. Kevin Warsh potentially coming in. And we have key economic data coming this week. Any of these could be the match that lights the fuse. The market doesn't need much to turn when the setup is this fragile. One headline, one data point, one shift in sentiment, and boom, the trap snaps shut. So, what do you actually do with this information? Here's my action plan, and you can adapt it to your risk tolerance. If you're currently long, holding stocks, first, take some profits. If you're up 15%, 20%, 30% this year, lock some in. Get some chips off the table. This is not abandoning your positions. This is being smart. Second, move to defensive sectors, healthcare, utilities, consumer staples. These hold up better in downturns than tech. Third, raise cash. Get 10 to 15% of your portfolio in cash. You want dry powder for when prices collapse. If you're in crypto, first, this is the time to be extremely careful. Don't FOMO buy at the lows, wait for capitulation. Bitcoin at $58,000? That might sound like a good entry, but it could go to $50,000. You don't know the bottom until it's in. Second, if you're holding, set stop losses. Bitcoin below $66,000, you're out. Ethereum below $1,800, you're out. Protect your capital. If you're in cash, this is where patience wins. Do not buy into a falling market. The best trades happen at the bottom, not at the top. Wait for the VIX to spike above 25 to 30. That's when you start looking for buys. The big picture. This isn't about being negative or scared. This is about respecting market cycles. Markets go up. Markets go down. Both are normal. What's not normal is being unprepared for the down move. And right now, if you're not prepared, you should be. Because the setup is in place. The warning signs are flashing. The data is screaming. All that's left is time. All right, let's recap what we covered. Number 1, record highs don't mean safety. They can be distribution points where smart money gets out. Number 2, 9 consecutive weeks of gains is exhaustion, not strength. Number 3, the divergence between stocks rallying and crypto collapsing is a red flag that the rally is weak. Number 4, watch these levels: 7,550 on the S&P, 27,000 on the Nasdaq, $69,000 on Bitcoin. If these break, we're in trouble. And number 5, the timing is now. This could happen tomorrow or next week, but the setup is undeniably in place. Here's what I want you to do right now. 1, subscribe to this channel. I'm posting market updates daily throughout this week, and you don't want to miss what happens next. 2, turn on notifications, hit the bell icon so you get alerted the moment I post an update if something major happens. 3, drop a comment below and tell me, are you positioned defensively right now, or do you think the market has more room to run? I read every comment and I want to hear your take. And 4, share this video with someone who needs to see this. If you care about your portfolio and you care about theirs, pass it along. This community is built on real talk and real analysis, not cheerleading, not sales pitches. And right now, the real talk is prepare yourself. I'll be back with updates as this unfolds. Until then, stay sharp. This video is not financial advice. I am not a financial advisor. Everything I've shared is analysis, pattern recognition, and my interpretation of market data. Past performance does not guarantee future results. Markets are unpredictable. Do your own research. Talk to a qualified financial advisor before making any investment decisions. Never risk more than you can afford to lose. Always use stop losses. Always have a plan. This content is for educational purposes only. Thanks for watching. See you in the next one.